Now to former Reagan budget director David Stockman, multiple best-selling author, on what he makes of this. Your concern is that whether spending it on programs or spending it on tax cuts, we're getting deeper in debt, right?
Well, that's true. $1.5 trillion they're going to add if they can hit their target. They're already at $2 trillion, and by the time all the bidding is over, in other words, you get rid of the loophole closers and you add more benefits to the middle class, which aren't in the current bill, we're going to be deep, deep, deep in red. And that is not a good thing to do.
We're already deep in
with
red,
$20
right?
trillion of public debt and $30 trillion built in over the next decade before this. Now, my argument is this is an economic dud, it's a political landmine, and it's an ideological imposter parading as a Reaganesque supply-side tax cut when it's nothing like that. It's a wish list of business in Wall Street. By definition, at the heart of supply side is marginal rate cuts. There are no marginal rate cuts in this. The top rate stays 39.6. There's a bubble rate that goes to 46%, above $1 million. Second, there's no individual cut in here. If you set aside the pass-through on business, right, which I have a different critique of, there's only $450 billion over 10 years of individual rate cuts. That's tiny. Individuals will pay $22 trillion over that period. This is 2.2%. It is.
You don't think it's enough to move the needle?
I don't think it'll move the needle. The third point I would make is this is not a middle-class tax cut either. If you take the heart of the middle class, which is adjusted gross income from $55,000 to $95,000, a third of them get a tax increase of $1,000 a year. 2/3 get a decrease of $1,000.
You're averaging it out over the 10 years because the
over
expiration
the 10 years,
of credits
well,
and stuff
the
like
credits
that. Right.
are, that's a gimmick, a short-term
right.
gimmick. If you look fully effective. So if you take the middle class as a whole, 30 million filers right in the center of the middle class, their average tax cut is $6 a week. 1 cappuccino, 2 cappuccinos, and a banana at Starbucks. That's all they're getting. All of this.
Starbucks sells bananas. But you raise a good. One of the things I said is the argument for this, and you and I have gotten into this before, David, is that something is better than nothing. I don't concur with that because I think that if you get something that feels like it's nothing, it's going to come back to haunt you at the polls. So I don't know if something is better than nothing. They might iron out some of these differences, but explain.
Yeah, I think it's worse because if you look at this, there are 4 big provisions that cost $2.7 trillion. They'll add to the debt. $200 billion of that is estate tax relief for 5,000 dead people a year. That's not going to help the economy that much, even if there is equity. $600 billion is for getting rid of the minimum tax. I pay it. I'm not going to do anything different except pay my tax accountant less. That won't accomplish anything. The other $2 trillion is for business cuts, and the thing we have to emphasize here is that workers don't pay the corporate tax rate or the business rate. Shareholders and owners do. So they're set by the world market. Wages are set by the world market. These corporate rates cuts, and it's $2 trillion, will go into share buybacks and dividends and other returns to capital.
So you have very little faith that they're going to plow this into plant equipment or hiring folks?
I think not at all, because number one...
But wouldn't sheer competitive instincts feed that they would almost, now after they've gotten their balance sheets in order, they would be compelled just to outbid for the other guy and the declining pool of talent that's available?
No, I don't think so. First
Really?
of all, we've got the lowest cost of capital in recorded history because the Fed has put the interest rate at practically 0 for 10 years. So
that's changing. It's inching up.
Inching up a little bit. But right now, there is no barrier to investment, equity, debt, capital, equipment, plant. It's all that can be done is being done. Tax rates aren't effective. Second, the reason corporations, the big caps, are going offshore is for lower labor costs. Let me give one example. IBM had 0 employees in India in 1993. It has 130,000 now. It had 150,000 domestic employees back then. It has 90,000 or fewer now. It went to India for much lower labor costs in the tech supporting industries, not because of tax rates. IBM's tax rate today is 11%.